Kathy Jones and Michelle Gibley. Kathy's the chief fixed income strategist, and Michelle's the director of international research. Great Friday team, ladies. Great to see you both. Michelle, we got to talk some China here still, because I feel like this is like a story that's almost like a sleeper contender for top 5 of the year, that with the weakness in their economy, they are still willing to press down even harder on their market. What have you made of this?
Yeah, I think, these new draft regulations for the gaming companies are likely to work against the appetite for investment by foreigners. China's recovery has been uneven, and part of the problem is weak confidence by both businesses and consumers locally. There's talk about being open for business from foreign companies, but these sudden changes in the business environment just are unlikely to give any confidence boost for both local and foreign businesses. So, China, that all said, China is likely to remain a dominant power in manufacturing for some time because it's really just difficult to replicate their large factories and supply chains. And there's a lot of pessimism priced into Chinese stocks. The PE, the price to earnings ratio, is in line with its 20-year low at 9 times.
Wow. That's after today or before? Did it get even worse today?
It didn't change much.
Oh, okay. All right. Because, some of these stocks are just getting hammered. But
right. I'm talking the overall market. Yeah.
Got it. Okay. So then what do we look for next year? What's the potential for them? Is there any potential for like a big China comeback? Like that was the one that eluded us this year.
I think that would be a big surprise. People are definitely, like I say, have low expectations for China. They have been reluctant to provide any kind of big stimulus to the economy because they're worried about, they have a lot of debt already in the economy, but that doesn't mean they don't have room to move. They're likely to hit their 5% growth target for this year. They'll probably be 4.5% to 5% next year. So they still have a lot of room to support the economy. They just have been slow to do so.
Okay. All right. Yeah, slow and like slower. Pretty amazing stuff. Some of the way the stock market has responded here. When the stocks were so cheap that they're able to keep getting hammered like this, it's like market's treating it as hopeless. There's got to be a bond connection in there, I guess, Kathy, when the second biggest economy is like getting in the front of itself constantly.
Yeah, weakness in the global economy is contributing to the sell-off, the decline in yields around the world and in the U.S. So we've seen significant weakness in the UK inflation numbers and the European inflation numbers. We're seeing inflation come down in emerging markets, including China. And that's keeping our yields low and our inflation low as well. I guess if there's any big surprise next year, maybe it's a turnaround in China. But at this stage of the game, it's been kind of a big disappointment this year in terms of global growth, and therefore has contributed to the drop in yields that we've seen in the U.S.
Okay, understood. So there's some bleed through, maybe not like the biggest factor, but it's there. Let's talk about this week. How the data come in your mind, Kathy, or is data only interesting if it's like wildly off track at this point?
So it was pretty widely anticipated that the inflation numbers today would come in. On the soft side, they did. The core PCE is now year over year getting really close to the Fed's 2% target on a 6-month rate of change basis. It's actually a little bit below 2%. So that was good news. That was baked in early. I think no matter what the Fed says at this stage of the game, we have various Fed members out there kind of push back on the early rate cutting expectations for next year. But as long as the inflation numbers keep looking soft, the market's going to run with it. The market's going to anticipate that the Fed's going to be aggressive in cutting in 2024.
Michelle, when we think about the central bank developments from the past week, fairly limited, but in terms of going into next year and kind of expecting that timeline, is it still looking like the Fed could be first out as it was first in?
It's possible. I would say, though, that, the Eurozone, the economy there has been very weak, much weaker than the U.S. And so to me, it seems as though the ECB would move first. And inflation has made a lot of progress there as well. But, Christine Lagarde did push back against the idea of cuts. She basically said they weren't talking about it at the December meeting. And they're also waiting to hear anything about wages. And that could postpone any kind of rate cut to maybe Q2 because they want to hear about how union negotiations, the outcomes of those.
Forgive my ignorance. What's their version of the dots? Can they say they're not talking about something and actually not talk about it? Because when we say we're not talking about it, dots say we are kind of talking about it.
Well, they don't have anything like that, but they want to push back because they want to make sure, they only have the inflation mandate. They don't have unemployment as another factor. So they're really just focused on inflation. It's come down a lot, but they just want more time to see how things evolve, particularly for the wages. That's where their concern is.
Okay, great stuff. Appreciate it very much. And ladies, have a great weekend and holiday. Thanks a lot for your time all year, and it's been a great conversation. Michelle Gibley and Kathy Jones.